After 6 years in the markets, one concept has consistently made me the most profits: supply and demand. It's not complicated, it's not a secret, it's the exact strategy that I would trade every single day if I had to start all over again as the beginner. Why? Because the big players, the ones moving billions of dollars, leave behind clues, and those clues are supply and demand zones. If you can spot where they are buying and selling, you can follow their footsteps instead of fighting against them. In this video, I'm going to show you everything you need to know about supply and demand, from entry to stop loss, the 4 confluences I use and which setups are high probability and which setups you should avoid. This is exactly how I trade, and I'm going to spill all the beans so you can trade what works and add it into your own plan. So grab a pen and paper, watch until the very end so you don't miss any of those valuable information I had from my 6 years of experience, and let's dive straight into the charts. So if you're new to the concept of supply and demand, or you kind of understand it but don't fully know the theory behind it, let's break it down step by step. Supply and demand refers to price areas in the market where significant buying or selling has taken place. These areas are important because they tell us where big money stepped in and shifted control of the market. For example, a demand zone is the little box we draw on the chart to highlight where strong buying began. You usually see large bullish candles with almost no seller strength. That's your clue that buyers were in full control. On the flip side, a supply zone is where sellers step in aggressively before a strong drop. You see big bearish candles showing selling pressure dominating the market. In simple words, a demand zone is like the discount shelf in the market, where institutions load up. A supply zone is like the premium rack where they sell off. Demand and supply zone don't just appear randomly. They form through a process. Think about when prices moving sideways in a range. This is where orders are being accumulated, aka buyers stacking up at cheap levels, or distributed, which means sellers unloading at high levels. Here's the cycle of how these zones form. Number 1, range, which means price moves sideways and orders are building up. Number 2, initiation. Suddenly, aggressive buying or selling causes an imbalance. Price explodes out of the range. Number 3, mitigation. The impasse can sustain forever. Price pulls back to the original area. Number 4, continuation. Institutions step back in, defend their positions, and push price further in the same direction. Now here's the mistake most retail traders make. They chase the breakout, price explodes, they FOMO into longs at the highs or shorts at the lows. But by the time they enter, the move is already over. That's why we wait for price to return to the demand or supply zone, where institutional orders are waiting. And that's where we position ourselves, or we put our stop loss at the wick of that previous candle. Why does price return to these zones? 2 main reasons. Number 1, institutions want to defend their positions. If they went long earlier, they don't want price to drop below their entry, so they will buy again when price comes back. Number 2, not all orders were filled the first time. Imagine a bank wanted to buy 1,000 lots, but only 600 lots were filled before price ran away. When price returns, they will use the chance to fill the remaining 400 lots at the same cheap price. This is why zones often act like magnets and why the strategy works. So how do we actually mark these zones on the chart? Here's my step-by-step method. Identify the last candle before the impasse. This is usually a small indecision candle, often with wicks, where nothing major happened. Right after this candle, you will see a big strong move. That's your leg out. Mark that last candle with 2 lines, proximal line and distal line. Proximal line means the side of the zone closer to the current price, and the distal line, which means the extreme edge of the zone, either the lowest wick or body for demand, or the highest wick or body for supply. Number 3, the box between the proximal and distal line is your zone of imbalance. For demand zones, the proximal line goes at the top of the basing bodies. The distal line goes at the very bottom, usually the lowest wick. For supply zones, the proximal line goes at the bottom of the basing bodies. The distal line goes at the very top, usually the highest wick. This keeps it rule-based and mechanical. The more rule-based your approach, the less emotion you will bring when it's time to actually put money into a trade. Now here's the truth: supply and demand zones and magic. Not every zone is going to hold. Some zones will fail, and that's just part of the game. But when you combine a strong leg out, a clean base, a higher time frame trend bias, and waiting for price to return instead of chasing the breakout, you stack the odds heavily in your favor. Think of it like this. Success leaves clues. Institutions leave behind footprints in the form of supply and demand zone. If you can learn to read those footprints, you're not fighting against them anymore. You're trading alongside them. Now, like all concepts in trading, supply and zone are not perfect. Sometimes they're just going to fail. You might have a demand zone marked, expecting a bounce, but instead price just cuts straight through it. That doesn't mean the strategy is broken. In fact, fail zones often give us powerful information. For example, when a demand zone fails, it tells us the buyers are no longer in control at that level. That flip in control usually means sellers are stepping in, and we can often find short opportunities targeting the next demand zone below. The same goes for supply. If a supply zone fails, that weakness can open up a buying opportunity into the next higher supply zone. So instead of just taking a loss and walking away, we can use the fail zones as confirmation that the market structure has shifted. They become flips, and if we are flexible enough, they can provide some of the cleanest trade. When plotting zones, keep it simple. Use the last candle before the impasse. If it is a bearish impasse, that last indecision candle at the top max supply. If it is a bullish impasse, the indecision candle before the rally max demand. But here's the key. Always align with trend. In an uptrend, we only want to focus on demand zones. In a downtrend, we only want to focus on supply zones. Of course, counter trend zones exist everywhere, but most of them fail. Why? Because you're fighting the flow. For example, on GBP/JPY 4 hour, when the market shifted from lower lows into higher highs, the focus should have been only on demand zones. Selling from supply would have been fighting against the stretcher. Instead, you look for extreme demand zones with imbalance, wait for price to return, and then ride the continuation higher. Supply and demand zone is not just about making zones, it's about how you trade them. For entries, one of the simplest methods is using buy limits at demand or sell limits at supply. Stops go under or above the zone. Targets, on the other hand, can often be supply or demand zones in the opposite direction. Even though we don't trade against trend, those opposite zones act as magnets. For example, in a bullish market, demand gives us our entries, but supply above gives us our take profit targets. Price usually won't reverse significantly until those areas have been filled. So they're perfect target zones. Now here's the truth. Not all zones are created equal. Most retail traders mark every base candle they see. That's why they get chopped up every single time. Institutions only care about high quality zones, and there are specific filters to identify them. Here are the 8 key criteria for institutional supply and demand. Number 1, breakout stretcher. Zones that caused a major breakout stretcher are stronger than those that didn't. If you want to know more about breakout stretcher, go watch this video right here. This is my breakout stretcher strategy that made me 6 figures in payouts. Number 2, flip zones. When supply flips to demand or demand flips to supply, that's high probability. Number 3, sweep zones. Liquidity sweeps. Equal highs, lows taken out. Signal institutional involvement. Number 4, inducement. Is there liquidity in front of the zone? Institutions need that to fill orders. Number 5, higher time frame alignment. Stacking zones across higher time frame massively increases probability. Number 6, multi-time frame contest. Higher time frame dominates lower ones, so always stick with the higher time frame. Number 7, premium or discount. Buy demand in discount, lower 50%, sell supply in premium, upper 50%. Number 8, freshness. And touch zones are the strongest. Each retest weakens the order flow. If a zone checks several of these boxes, it's likely institutional, and therefore higher probability. And remember, the best zones are always fresh. Tester zones lose their edge because institutional orders are already filled. Finally, let's talk entries. Some traders take every zone blindly, but I prefer confirmation entries. That means dropping to a lower time frame once price taps to the zone and waiting for the smaller time frame to remove an opposite zone or trend line. That way, instead of just hoping the zone holds, you're getting confirmations that the institutions are stepping in again. This keeps you patient and focused. You're not trading like the machine gun spraying everywhere. You're trading like a sniper waiting for the A+ setups, only pulling the trigger when momentum proves the zone is real. So that's the full breakdown of how I trade supply and demand. Now don't just watch this and move on. Go back, mark out zones on your charts and practice. The more reps you put in, the more your eyes will start spotting A+ setups instantly. Remember, not every zone will hold, But when you stack confluences and trade with the trend, you tilt the odds massively in your favor. If you found value in this video, smash the like button so more traders can see it, and subscribe to the channel if you want more real and practical trading strategies that are actually used in the markets. Drop a comment below and let me know what part of supply and demand click for you the most. Thanks for watching. See you in the next video. Ciao, ciao.